Welcome to this First Voice webinar, which is brought to you in partnership between First Voice magazine, the official flagship magazine of the Federation of Small Businesses, and Dell Technologies, the leading provider of tech solutions to small businesses, whatever your stage, size, or need. This webinar is titled Securing Finance to Set Up or Scale Up, and we'll help you understand the different funding and finance options open to small businesses, what investors and funders are looking for in the businesses they invest in, and what you can do to put yourself in the best possible position to achieve funding. To help explore this topic, I am pleased to say that we're joined by two experts in this area, each with a very different role and therefore different insights. Latha Matz is CPO and co-founder of Finmarie, the first financial platform in Germany that's dedicated to helping women focus on investment and financial strength. With more than 20 years of building IT and e-commerce teams, she's solved complex problems for companies ranging from FedEx to freshdirect.com. Recognized as a leader in technology and startup development, Latha is a frequent speaker on topics ranging from fintech, gamification, and financial health to data management, remote working, and startup management. Latha is also an EU tech ecosystem connector, a mentor and judge for the Metro Accelerator by Techstars, the eBay Startup Cup, Impact.org, and the Tex Factor Female FinTech Hackathon. So plenty of expertise to share with us today. Meanwhile, Adrian Innes is Chief Revenue Officer at Fundpoint, a free platform that helps businesses get a better deal for finance, insurance, and other services. Adrian is a highly accomplished business development leader with 37 years experience in financial services and a passion for helping small businesses succeed. And prior to Fundpoint, Adrian managed and mentored multi-skilled business development teams for Lending Crowd, Clydesdale Bank, and RBS. And Adrian volunteers in his native Scotland, supporting a range of worthy causes. Latha and Adrian, thank you so much for joining us.
Thank you.
Pleasure to be here. Thank you.
It's good to have you. Thank you. And in terms of format for the session, we're going to spend the next 30 minutes or so running through Latha's and Adrian's views on the types of funding available, whether funding is right for your business at this time, what investors are looking for, and what you can do to position yourselves to achieve funding. And then following that, we'll open the session up to you, the audience, to pose specific questions. On that note, you can submit a question at any time by typing it into the question and answer button at the bottom of your screen. So you should see a little Q&A button right there at the bottom. If you click in there, you can type a question at any time, and I'll keep an eye on those, and we'll pick out those questions at the end and share them with our panelists. And just finally, before we get into our discussion, I'd like to let you know that our partner today, Dell Technologies, is offering all attendees the opportunity to take advantage of a raft of tech discounts, and a discount voucher will be emailed to you in the form of a PDF after this webinar, along with a link to a recording of today's session. So after all of that, we've got a lot to cover, so let's get going. I thought a good place to start, Adrian, first perhaps, and then Latha, is if you just give us a short overview of your organizations and the role that they play in helping firms achieve funding. Adrian, just give us a quick overview if you don't mind.
Yeah, so thanks very much for the opportunity to speak with so many people today. I suppose if you look at Fundpoint, we work as a partner with the FSB funding platform. So we have proprietary technology that does the heavy lifting in relation to connecting those who want to borrow money with those who want to lend money. So between funders and borrowers, we have over 136 funders on our panel, ranging from high street banks to alternative funders, challenger banks, so asset finance, invoice finance, short-term, long-term, secured, unsecured. I like to say that as long as it's legal and legitimate, we will have a funder who could consider funding it. We work exclusively with, the team with the FSB funding platform to help secure funding on behalf. So, for example, very quickly, if you were to complete an application within the FSB funding platform, we may be able to connect you with 5 or 6 different funders. If you were walking the high street going to, a Clydesdale Bank, a Royal Bank of Scotland, a HSBC, you're telling 5 or 6 stories to this different people and trying to explain it. The biggest issue, and again, when we get into the Q&A, I think, is trying to get the person who needs to borrow the money to really understand why they need to borrow the money, because a lot of applications come under the umbrella heading, which is working capital. Now, working capital is, as I said, an umbrella heading for 7 different types of things within the balance sheet, whether it's debtors, creditors, stock, work in progress, from that side of it. So truly understanding the reason why you need to borrow the money, and then being able to actually look at the correct product that will meet your funding requirement, not just today and certainly in the future. And it's quite apt today. We're going to look at startup to scale up. Indeed, we also look at exit positions as well. When somebody is looking to exit a position, what's the best thing to present from that? So, a unique team that works, with the FSB funding platform. A 5-minute application, gets you a dedicated person like myself to help. And I think the key thing, I'll throw this in here to start with, how do we get paid? Because most of the people on the call will say, well, what's the benefit for you? Is we actually get paid from the funder. So if you were walking into Lloyds Bank, for example, looking to borrow £100,000, first of all, I don't think you'd know anybody to speak to. There's no relationship managers nowadays. It's all call center driven. From that side of it, where we do have dedicated business development managers who work with for all the funders that we work with, 136 funders, 200 different products. So if you walked into Lloyds Bank, for example, and they made you an offer for £100,000 of debt, and they were charging you a 2% arrangement fee, coming to us, if we placed that deal with Lloyds Bank, they would still charge you a 2% arrangement fee. What they do is they pay us a proportion of that fee, and that's their cost to originate. So in reality, their cost of sales to originate opportunities that are coming through from the various channels within UK business, finance, FSB, or Chamber of Commerce relations that we have. But we help people get funding. We provide advice on research and development, R&D, innovation grants, and we help pinpoint. When I say about advice, we've got to be very careful about that word of advice. We do not advise who you should get your funding from. We provide you with enough information to allow you, the borrower, with enough information to make an informed decision on who you want to actually take your funding from. Because at the end of the day, the contract is between the funder and the borrower. So delighted, looking forward to today, looking forward to some interesting questions, and maybe actually spelling some of the myths out there in relation to funding.
Yeah, that's great. And Lisa, welcome. Thank you also for joining us.
Yep.
I touched on your sort of experience around enabling women to access some finance, but just give us a sort of bit of an overview around your specific areas of interest.
Yeah, I'll keep it short, because Finmarie is actually a B2C. So we are working with individuals to help them achieve financial strength over time. One of the things that we're doing that's really, I guess, relevant to this topic area is right now working on an accelerator program to get specifically women into angel investment. So when we talk about the different kinds of investment for small businesses, angel investment and these kinds of syndicates are one of the opportunities that small businesses can take advantage of. And so we can get a little bit more into the various types of investment that are available to small businesses. But yeah, for this this session, I think I can speak on behalf of running a small business and doing fundraising a couple of times. So I've been to that rodeo, and then also being on the other side, evaluating startups and evaluating businesses and talking to a lot of people in the industry about what it is that they're looking for. And again, to Adrian's point, there is a lot of mythology around what fundraising is, a lot that you see in the media that's actually not true. So looking forward to doing a little bit of myth busting there as well.
Good, and it's great to have both sides of somebody who's got experience from both sides. Let's come to that kind of myth busting bit, if you don't mind, later. You know, it's a complex area, and there's a lot of sort of myths that people hear about business funding from the media and elsewhere, but I think that's probably quite distorted. Just talk us through some of those sort of misconceptions.
But I think if you read the articles or about startups, or if you're paying attention to what happens in the industry, you might get an idea that, oh, you just need a great idea, and then people will start throwing money at you, and that's actually incredibly rare. So there are a few people who can do this, but it's mostly because they have a prior track record. So this is somebody who is like Elon Musk, coming from PayPal. And of course, people have a lot more interest and faith in the next thing that he's going to build is going to be a successful thing. So you really do have to establish why you're going out for investment. And I think, Adrian made this point as well, that not every investment type is right for every business. So there's the correct match there. And I think a lot of people hear a lot about big venture capital raises, and they think, oh, well, I need to go for venture capital. But once you get on the venture capital track, you don't get off it. There's a specific track that venture capitalists are looking for. So if you have a $1 billion concept, if you have product market fit, and throwing money at your business is going to immediately help you scale and get to that $1 billion potential, then maybe VC is right for you. But in a lot of cases, it's not. And so I think in this session, we can talk about some of the other options that are available, whether those are grants, whether that's the seed funding through angels, seed funding through friends and family. So those are really common at early stages, and also, loans. That's also a really legitimate way to grow that maybe doesn't pressure your company to grow with KPIs that are not right for you and your business. So that's something I see too. If you're going for VC, they want you to grow at an extremely rapid pace, and it's not necessarily going to be the right thing for your business, for your customers, for the way you want to grow your idea. So I mean,
Yeah.
there's a lot to say here, but I think that's where I would begin as far as myth busting.
Yeah, there's quite a few. Adrian, did you have anything to add around that before moving?
Yeah, absolutely. There's a lot of things said there that I would echo, confirm, but also endorse. And I suppose that there's a dichotomy between equity and debt, and it's when do you get to know whether you're ready for equity or ready for debt. And it's in relation to where you are in the sales market and whether you're actually pre-revenue or not pre-revenue. And also whether you want to go for, equity funding through an AIS scheme effectively, or whether you want an investor to have part control of your business. Latasha, you talked about KPIs not being right for the business. That's because a controlling interest is coming in and telling you the pressure of their wanting their return within a 5-year period. Is there other sources of revenue we can use? And one of the things, hopefully we'll get into a wee bit more discussion today, is the British Business Bank, UK Business Finance have just extended the startup loan scheme to within 3 years of trading, where it used to be 2 years. And they've also said, you can top up if you've been trading within 5 years. So, if you are starting a business, it's not a dragon den scenario. You don't want to sell your soul, but you have to appreciate that. What have you invested into the business equity wise? What cash have you done? Have you protected it with IP? What's the value of the IP? And IP, unfortunately, is only worth what somebody's prepared to pay for it at the end of the day. So, a goodwill within the balance sheet is not recognized by most funders. when we're looking at that. So are you prepared to put up a personal guarantee or indeed maybe heritable security of a dwelling house or commercial premises? But I think one of the key things is when we talk about the difference between whether you're equity ready or whether you're debt ready in relation to revenue generation. Now, there are funders out there that will provide you with an interest only loan for 1 year, knowing that the investment going into your business will get you debt ready. So therefore you can start repaying the debt within that 12-month period. It's all about the story. It's all about your business plan. Businesses, funders, they look at financial acumen, business acumen, and personal acumen. So they're checking all of these facts to say, well, what makes you the character? What skills do you have to drive this business forward to make it profitable going forward? We talk about unicorns in the UK to a certain degree, but they're billions, so in value, not the numbers of that happen, but it's being able to articulate the story to the funder to look at whether it's an equity-based play, be it VC, or whether it's seeders, as you've sort of alluded to there as well, or whether there's an element of debt. Sometimes it's 50-50. You can go to a funder and say, well, we've got equity investment coming in of 50,000, so therefore we're able to leverage that to 50,000 of debt from that side of it.
Yeah, and I think I just want to remind our audience, we are receiving some questions in the Q&A, but do feel free to also share yours if you have any along the way. You don't need to wait for the Q&A at the end there for that. You can just click that Q&A button at the bottom, submit your question, and we'll be picking those up throughout the session. Some good debunking of myths taking place there. Thank you for that. You've both also sort of touched on quite a few different types of access to funding and finance. Can I ask you just to recap perhaps the one or two most likely, most common routes for small businesses? Adrian first. I just think it's really good for our audience to get that nice and clear. Yeah,
so within Fundpoint and our partnership with the FSB and the funding platform that we work with startups, we work with early stage, and we work with mature businesses. So there'll be a different person within our teams that will actually, specifically be qualified on startup loans, which is up to £25,000 worth of debt. But it's a personal loan to the individual, to the directors of the company. Therefore, if you've got 4 directors, up to 100,000, it gets invested into the business, whether that goes in the share capital, whether it goes into, obviously loans by way of, equity loans sort of thing going in is different, or debentures going through. You then get the other, once you've been trading for another number of years and you've actually proved debt serviceability. I think the key thing that all businesses need to understand, we've been through 2 years of turmoil. We thought COVID was going to last 3 weeks, and today, the 23rd of March, I believe, is 2 years to the day when lockdown was about to happen for the first 3 weeks, and then 6 months, and then all of a sudden we're 2 years down the line. So a lot of businesses have had to close. Hospitality and leisure, for example, forced closures. It's now being able to actually project, why you need the money and how you can actually afford the money. So it's almost asking yourself, before you go to a funder, the questions that you think the funder's going to ask you. So, and the biggest common issue that I find in relation to business planning and cash flow forecasts is you can speak to a director of a business and walk them through the cash flow forecast, but they don't know the answers to the methodology of the calculation of the actual, projected turnover of £1 million, because maybe their accountant's done it for them or their financial director's done it for them. So I'm drilling down on the first question I ask most businesses is, what's your break even? And they say, why? I say, well, tell me how much you need to generate in the calendar month, calendar year to actually just break even. That's not make profit. That is just to pay the bills. And the majority of the bills, overheads are consistent to a certain degree, other than your cost of sales. They will change in relation to the level of turnover that you've got. But you should be able to know what your rent, what your rates, what other expenses, salaries in proportion of that side of it, kind of a thing. So I think the whole thing for me is you've got to prepare. And that's where we come in as, Fundpoint and the FSB funding platform, is we help businesses prepare for the engagement with the funder. we negotiate with the funder on behalf of the business. You know, there's many a time I've been on a tripartite Zoom call, for example, with a funder and the customer, and I am able to articulate the financial position and the projections going forward, whereas the business owner is so immersed in running the business might not be able to project that as well as, you know, 37 years of experience can do, you know, to help try and get a funder there. It's a difficult market just now. You know, we've gone through Sybil's, we've gone through Bibbles. You know, I think the schemes have been absolutely fantastic, whether they've been fraudulently utilized to a certain degree at the pace they came in with the Bibble, for example, and you know, limited companies being set up. Sybil's was a wee bit more scrutinized in relation to debt serviceability. We've got recovery loan scheme that's due to come to an end in June. What will replace that? Even British Business Bank at the moment can't tell us what it will replace by, albeit maybe back to small firm loan guarantee or EFG that was there previously. But it's allowing us to help provide, you know, those who want to borrow money with the correct information to be in the correct position to present your application. So truly understand your cash flow forecast, truly understand what your break even is, and then do a 70% top up or 100% top up so you get to that side of it. Truly understand the reason why you need the money, because not a lot of businesses know why they need the money. They know they need money. They don't know where the capital is tied up in the balance sheet to either invest in their business or actually to pay the wages that they need to actually pay for.
Brilliant, thank you, Adrian. Anything to add on that, Latha?
You know, I would also add that from the startup perspective, I think it's really useful to begin from the end of your story. So what is the end of your story? Where are you going? Because if you're ultimately looking for an acquisition, then maybe the funding option that you're looking for is actually that you are joining an incubator with, for example, a larger company that wants to initially invest in you to see if it's a good match ultimately for them. When you look at the long term, I think Adrian pointed this out as well. If you do an option like equity crowdfunding, that could be good as a consumer brand. You know, you might have a great marketing angle for that, but it could complicate your later rounds if your later investors look at that and say your cap table is messy. So the thing that I would always advise is, you know, of course you've got loans, you've got credit, you could do a funding round. If you do a funding round, how many people are you bringing in on that initial funding round? That could also be complexity for your cap table. If you're doing VC, you have to figure out if the VCs that you're going with are going to be compatible again with your future, you know, end game. There's also the option to, you know, I hear very few companies doing it, but to do friends and family, you know, just self-fund and look to creating revenue so that you don't have to take additional equity dilution as you go forward, right? So think about how you want your business to grow, where you want it to go. Do you want to grow it yourself over a lifetime and have this to be like a self-sustaining kind of a lifestyle business that you do? Or do you want to do like the VC route, or do you want acquisition ultimately by a larger company? When you look at it from that perspective, I think it can color which of the choices is right for you and right for your cap table going forward.
Question. Look, you know, small business owners want to know how much this is going to cost, and I know there's no standard rate for borrowing finance or accessing finance, or, you know, certain percentage of your business that you might have to give up and so forth. But could you give us a sense of just, and later I'll come to you first if you don't mind, but could you just give us a sense of what you might typically give up if you're looking for investment in a quite early stage of your business or to scale up? And then perhaps Adrian can talk to us a bit about how much that costs to access finance, you know.
Well, you know, and I think we're both going to tell you the unsatisfying answer, which is that it depends. It depends on how your investors feel about the strength of your team. It depends on, are you creating revenue today, and how quickly are you building that revenue? Do you have a lot of users already? You know, if you know, what are the things that you have that are already valuable in your business? So if you have property, if you have IP, if you have patents, and you have a product with an unstoppable USP, or something that is just so special about your business, then of course it's going to cost you a lot less to get money, right? Like you have the enviable position of calling the shots at that point. If you're an unknown team, if you haven't already proven your value, this is the negotiation that you have with whoever is loaning you money, and you have to figure out whether the strength is on your side and you have an advantage and you have leverage or not. I mean, I'll let Adrian actually give you numbers, but those are some of the things that you know, I know from my experience that make the price more or less for you and for your future options in the company.
Yeah, thanks for that. I think you know, in 37 years, the key principles of lending have not changed. So I'll give you two policies that all funders will work with to a certain degree. They look at what's called a primary exit, and they look at a secondary exit. So primary exit is the ability to repay now or in the future. So if I invest £500,000 into your business and it's interest only just now, will that get your business into a position where you can afford to repay capital and interest over a period of time for the next 5 years or 10 years, whatever tenure of the loan is? Secondary principle is security. So, you know, am I going to look for personal guarantees, or am I going to look for a debenture, or am I going to look for some form of heritable security, be it, you know, a charge over a commercial mortgage or a charge over your residential dwelling house? But, you know, the second part has only ever been a comfort factor to funders, probably more so moving forward. But if you look at the first part, it's, you know, the majority of funders do debt serviceability calculation based on what they call EBITDA, which is earnings before interest, tax, depreciation, and amortization. And then if anybody wants me to send them a schedule on how to calculate what that is within their own sort of profit and loss, I can send that on to them. And then it's a multiple of algorithms that they build into their platforms that allow them to risk assess the proposition. So for example, let's go from A to D, A being the best proposition, D being slightly higher risk. And then there'll be a formula built into that in relation to the price. And that directly correlates to the algorithm in relation to the probability of default. Probability of default is how many people I lend money to are not going to pay me back. And if they're not going to pay me back, am I going to get 30 pence in the pound? Am I going to get 25 pence in the pound? Or is it a complete default and write-off position? So there's a number of different methodologies that goes into the calculation of interest rates. A lot of people, you know, obviously bounce back loans came out at 2.5% above Bank of England base rate. We've seen Bank of England base rate increase, you know, a couple of times recently, and probably going to increase because inflation going the way it is. You know, the economic factors with inflation is people aren't spending more, they're just having to pay more for petrol, gas, electricity, and normal food, haulage costs, everything going through the roof. So it's not if people are extravagantly going out there spending money they don't have. So there will be a knock-on effect in relation to, you know, Bank of England base rate going forward. It's not going to go up to the peaks of what it was in 16% back in probably 2004, 2005, when it went up to that. But it's been able to, one, prove the ability to repay the debt, and to give you interest rates they're as long as they are breadth, unfortunately. We will have funders, and again, it depends on what you're looking to borrow for. So if you're looking at a trading business, with, let's call it a working capital facility, it could be 1.89% per annum, and it could be 17 or 20% per annum. We have the full funders on panel that start at 1.89 per annum, and we have 45% funders per annum. Depending whether you're looking for maybe a revolving credit facility, whether it's a cash advance facility, or all the interest rates. But when I speak to every funder and we look at the price of the funding, I'm asking him or her to say, well, when this money is invested in your business, what return are you going to generate? Are you going to generate a greater return that has the impact on your gross profit and net profit than what you're going to pay in interest? If the answer is yes, then it's potentially the right solution for you, because you're increasing your revenue over and above the costs that you'll pay. But it's about what you're willing to give up. And again, touching on bounce back loans, bounce back and Sybil, 90 odd billion pounds went out in 2 years. If you look at the previous scheme, through small firm loan guarantee and EFG, it was something like 10 billion over 5 years. So a lot of money's gone out, and a lot of customers are reluctant to provide personal guarantees. And again, I challenge that to a certain degree to say, well, if a personal guarantee is only going to be called upon in an event of default, and a lot of things have to happen over a 12 or an 18-month period before that, actual default is called upon. You could refinance your position, you could raise extra funds from somebody else if there was a business turnaround proposition. So are you willing to trust yourself and trust your business that it's heading in the right direction? If you provide a personal guarantee, your interest rate might be slightly cheaper. If you're unwilling to provide a guarantee, then it might reduce, well, it definitely will reduce the number of funders that are out there that will be willing to fund, because they're taking a higher risk, and their probability of payback is obviously negligible compared to somebody who has a guarantee or indeed heritable security. So it's probably not the answer everybody wanted, because it's horses for courses. But I suppose that the good thing is working with ourselves through the the FSB funding platform, and Fundpoint, the business I work for, is effectively we help guide you through the advice. And I use advice as an advice, but I will say this again: we cannot advise you on taking a loan. We can only provide you with enough information to actually allow you to make that decision yourself there. But it's having somebody there that can actually give you the information you need to make a decision. And sometimes it might be it's not suitable for you, and we might need to try a different avenue.
I would also say, that for startups that are doing VC, there are some easy kind of rules of thumb out there when you start doing your pre-seed, your seed round. You do want to make sure that you keep the equity that you're giving away, definitely less than 20%. Only in extreme conditions would you do any more than that. And it's already like, the more you give away, the less you're going to get at the end, because you're just going to be diluting your own shares in the company going forward. So and
looking at the VC element is, is that person going to be too involved in your business? Is there going to be clashes of characters and personalities pulling in different directions? When you have your monthly board meetings, have you got in bed with an investor that you principally will not get on with, and therefore causes bigger diversions in the business to where it wants to project to?
Yeah, those are great points. And just we've got a fair bit still to get through, and I want to get to some of the brilliant questions we've been receiving. But just in a word, has borrowing become, you talked about costs going up during COVID, Adrian, has borrowing become more expensive and harder to achieve as a result of COVID?
Simple answer is yes. Because, yes and no. So I'm going to sit on the fence here a wee bit, I suppose. If you look at high street banks are still going to be the cheapest funder out there. The reason why is because they're balance sheet driven. They're lending their own retail investor money. So, Lloyds Bank might be sitting with £10 billion of retail investor money where they're paying nothing to the retail investor. They're able to lend that off balance sheet. against the probability of default. If you look at challenger banks, and if you look at maybe alternative funders, they have to go and borrow that money from somewhere. It may be international, they may be going worldwide into, you know, whatever part of Europe they're going into, or indeed the world, and they're having to pay a margin of price. So you'll find that certainly alternative and challengers will be slightly more expensive than the high street funders. What I've found, and this is not criticizing any of the high street funders, is they've retracted from funding at the moment. They're focusing on some of the recovery that they need to do through the bounce back loans and the CBIL loans that they've got. And they may be supporting their own customers to a certain degree, but won't be supporting any new customers coming in to the marketplace. So again, it is about making sure you have the right solution for what you need. So looking at interest rate, looking at exit fees, looking at in fees, and we deal with, you know, invoice finance, asset finance. We deal with secured lending. We deal with bridging, short-term, long-term, you know, solutions. So, you know, we are dealing with a number of significant funders, but, you know, we will help you walk through the interest rate. There are some funders you pay back on a weekly basis, you know, and you know, net cash advance on you know, revolving credit facilities. Yeah. But high street banks are going to be the cheapest possible solution, given that where they're funding on balance sheet and everybody else is funding off investors.
And we talked about, you know, this is called funding for startups and scale up, and obviously, you know, when the right time to start up is, because you've got your idea and a way you want to go. But to scale up, not every business is sure when the right time to scale up is. Have either of you got any guidance on that? I mean, Latha, you know, how do you know it's the right time for you to embark on seeking some finance to scale?
Well, your ideal situation is of course your product market fit. Like if you have more demand than you can meet, well, it's time to scale. You know, that's the kind of ideal as an investor, is like, wow, this is a business that only needs me to give them, you know, 100,000, and they are just going to take off, right? That's an investor's kind of ideal situation, and it's like a proven product market fit. So if you can feel that you have that, if you can see that, like, oh, if I only had you know, this much money for this facility, or this much money for this group of resources to put together my product, then I could do this. That's the story that I think a lot of individual investors definitely want to hear, and I think Adrian can probably speak to the retail investors and how they're looking at this. But I would say that if you have also something that you know is going to create your next leap into a new realm. So if you are adding automation to your business in a way that is going to give you a real jump up, then, you know, that's also potentially a story that you can give for example, grant investment or investment to do that next jump for your business. But you need to have in your mind already that story of, like, look, we are on the path to success. So either you're getting on board or you're missing this boat, because we're moving in this direction already.
Yeah, and Adrian, feel free to come in on that. But can you also start us off on what it is that you've touched on? You know, providers will look at EBITDA. You've touched on the fact that you need to get, you know, they want to see that you're on top of numbers and you understand your story and that narrative. Tell us a bit about what small businesses can do to put themselves in the best possible position to obtain funding and finance.
Yeah, I suppose we touch on the story and the narrative, and you know, a cash flow forecast is important, but for me, the assumptions behind the cash flow forecast is more important. So what diligence have you done, you know, to prove to me if I'm taking, and let's call it a punt for, you know, just a terminology, in relation to lending you 50 to 100,000 pounds. What have you done your homework? You know, we've touched on business acumen, personal acumen, and professional acumen, which would all be done through, you know, your past career highlights. You don't have somebody moving significantly from sector to sector, that's going to be an expert in that sector, they're moving into, how do they all of a sudden become a sector? But for those on the call, a very simple story from, this is 25 years ago. And a gentleman approached me when I was a manager at the Royal Bank of Scotland in a place called West Hill in Aberdeenshire. And these were the days when the manager shook your hand and he lent you the money. So it wasn't going through algorithms. It's, it was a personal decision. You signed off on your own decisions. And he came into me and he was looking to borrow £50,000 to open a cafe. Now, West Hill is a small outskirts, 12,000 population on the outskirts of Aberdeenshire. Affluent to a certain degree, not significantly affluent, but you had the oil industry up there. And he came and he says, I want to borrow £50,000 and my turnover in year one is going to be £500,000. So he had a cash flow. And I said to him, just talk me through the assumptions behind your cash flow. And because his cash flow was granular, and he had taken £500,000 and divided it by 12. So we know all businesses have a degree of seasonality. They have peaks and troughs. So he hadn't done his homework to any degree. But I was saying, okay, if you're going to generate that £10,000 per week, how many cups of coffee are you going to sell? How many sandwiches are you going to sell? What's your average take from the till? And give me the assumptions that will allow me to believe that you can do this. I knew there was probably half a dozen different cafes in and around the West Hill, Aberdeenshire area, which would be direct competition to him. And he hadn't done his homework. So unfortunately, I said, not at this time. Go away, do your market research and come back to me. And what he did is over the next sort of 3 or 4 weeks, he went into every one of these coffee shops, 9 o'clock, 10 o'clock, 11 o'clock, 3 o'clock, 4 o'clock. And he sat as close to the till as he could to see what was being rung up. He could then come back to me, and when he came back to me, and to justify his turnover, it wasn't going to be £500,000 he was going to generate. It was going to be something like 275,000. But he could then say to me, the average ticket price at 9 o'clock in the morning, which was a bacon roll and a cup of tea, is £2. The average ticket at lunchtime slightly higher because you're getting a sandwich and something else is maybe £3.50, and in the afternoon it drops off just to the coffee. So he had actually done his homework to be able to say that he'd really investigated the opportunity he wanted to go into. And I think that the key thing when you're looking at startup finance is sometimes if it looks too good, it is too good, but being able to have done enough diligence. And I jump back to something I probably said about 45 minutes ago, is ask yourself the questions a funder is going to ask you. And somebody coming through the FSB funding platform, I'm going to ask you those questions, John. And if you don't know the answers, I'm going to ask you to go away and work on them before we put you in touch with funders to make sure that there is marketability there and scalability and the story. But when you're looking at your cash flow projections, as I said again earlier on, what's your break even? How many cups of coffee or tea cakes do you need to sell on a calendar day just to pay the wages? And then you work what your margins and your profitability is there going forward.
Brilliant. Laith, anything to add on kind of getting yourself in the best possible position?
The thing that I would add here is something I think we haven't touched on yet, which is the quantity of time that it takes to do fundraising. And I think people underestimate that because I think you really should budget months and months for this. Some people say 6 months. I would say give yourself 9 months. Make sure that you have the runway to get through that 9 months comfortably, because you don't want to get to the end of your runway during the process of doing your fundraising and have this position of being cornered. Okay, I have to lay off all my staff now because I didn't allow myself the time to do the fundraise correctly. So a lot of stuff can happen even after you get the term sheet. If you're getting, for example, equity fundraising. And the thing that Adrian just said here too about, you go in there, you think it's a sure deal, it looks good. He comes back to you and says, your unit economics don't make any sense to me. go back and fix that. So it could be another 3 weeks, add on another 3 weeks for, Christmas holidays or whatever it is. You really need to think about the time that it's going to take to acquire this funding, and make sure that you're in a good position and a comfortable financial position to do this. It's one of the mistakes I see people making all the time is they're like, if only they would have gotten that term sheet like a month before, then they wouldn't have had to go into bankruptcy. Or if only the term sheet that they'd gotten would have actually gone through, then they would have been able to continue the business. But don't paint yourself into a corner.
No, and you're absolutely spot on, because one of the biggest failings we say when people are looking to borrow money, it's too late. They need the money then and there, and if they need the money then and there, it's going to be expensive if someone's going to fund it, because it's going to be an immediate request. You should be looking at your cash flow forecast, and it is a forecast, so therefore review it 3 months, every month, project it out to 12 months, and then go to a funder, with a 6-month window to say, so we're funding a deal that's likely to close tomorrow where they've asked £250,000. And based on the last 3-year accounts, that we will only be able to get them 125,000. But the reason they need to borrow the money is for a 2-year gig based on their cash flow forecast. So we can do stage funding. So we can get them £125,000 today. That will allow them to get onto the next stage, to allow us to reapply. And we've already spoken to the funder to say, look, we're going to be coming back to you in 6 months' time if we've hit the projections and the KPIs that we've said we are, for another 100,000. And they've already said, well, yeah, we'll cross that bridge when we come to it. But based on the projections that you're projecting, that shouldn't be a problem for us. But that's for a specific purpose. If you're looking to buy machinery, it's different. It's about the prep in advance of going to, because as I've said, there's a lot of people come to us and say, look, I need to pay the bills tomorrow. And we're saying, well, you should have thought about that 3 months ago.
Yeah, timing is important. Moving to the questions, if I may. And one of the questions a few people have asked is around, time was one of them, so thank you for that. And another one was very much around amounts. Is there a sort of minimum, maximum, or typical amount that a small business might look to acquire through the platform agent? Is there a sort of, a pretty mean average amount that sounds about the right amount that a business will look to access?
Again, it's a very difficult question to answer, because it's all based on debt serviceability. So, and it depends on the facility that you're looking for. If you're looking for, if you're in construction and you're doing a bridging, to convert a building and your GDV is profitable enough, then you'll get a higher amount. If you're a standard trading business, they'll look at profitability and they'll look at turnover. And, what pays the bills is ultimately cash in the business. Likes of iWalker, for example, will go on, a multiple of turnover. If you look at even the recovery loan scheme just now, the recovery loan scheme, they say will either fund 25% of your turnover in 2019 or 2 times your annual salary bill. So, there are criteria, but the bottom line is affordability. And the worst case scenario is funders will look at EBITDA times 1, so earnings before interest, tax, depreciation, amortization times 1. The higher the risk level, they may go 1.5 to 2 times multiple. One of the things you have to be cognizant of is, especially with limited companies, is directors' dividends that comes off the bottom sheet. And I've seen a lot of businesses making £100,000 of profit, but directors' dividends are £110,000. So effectively, you've got a negative equity position in that year. And you then got to ask the director, is it a nicety or is it a necessity? So can we get a statement of assets and liabilities to say that if you only needed to draw £50,000 a year, that would add back to the profitability. The other thing you can look at is, share capital, or whether it's actually directors' loans. If you capitalize directors' loans, it improves the balance sheet and the bottom line on the balance sheet. So again, could have a better position from there. But, and the simple answer is affordability and being able to project affordability.
Yeah. And just coming
I'd also
later.
just add to that
Yeah, feel free.
utilization. Yeah. So for example, you should have a very clear idea of like, what are we spending this on? You know, it can't just be your vanity. You know, you can't just say, oh well, you know, I got this much funding because I'm great. No, it's got to be for things that are building the business. So it absolutely depends on what is it that you need to build the business to the next level. That's what it's going to cost, and that's what you're going to go for funding for.
And,
Yeah,
in relation to equity, just to jump in there, you know, it's truly understanding your methodology of calculation. So, you know, if 5% of your business is £1 million,
yep.
How have you valued your business?
Yes. Yeah.
Are there just a few sort of specific questions, I guess, around people's specific areas of interest? Can you just give us a sense of whether it's more difficult, you know, if you are a sole trader versus a limited company versus a company, for example, whether being a limited company puts you in a better stead, better opportunity to gain funding? And also, people have been asking a little bit around sort of borrowing to invest in tech or property before they're actually got a product in market, and how difficult that type of thing is. So there's a few things there, but there's some specifics, Adrian, that you could come in on.
Yeah, so if we take the sole trader partnership and limited company or limited liability partnership nowadays, as they have, there are some funders we have on panel that will not lend to a limited company. And I object to that, because if you're a sole trader, you've got 100% wholly liable security, because you are the person that they will come after. You may not be signing a personal guarantee, but you know, you are, you know, undisputable, you know, if they want to actually foreclose and come after you for that debt. So sometimes there does become an issue in relation to if you are a sole trader. You also have to watch from going from sole trader to obviously limited companies, any capital gains obligations or tax implications from moving. So I would always advocate everyone speaks to, you know, their independent accountant sort of thing on that advice. There are other things you can do. Is you could set up a limited company with a view to borrowing the money in the name of the limited company for a specific contract, and then almost have, they're not called cross-company guarantees because you've got a sole trader to a, you know, a limited company, but you could use that route. But there are unfortunately some funders out there that will not look at sole traders.
Yeah, I would echo that to say that also you need to think about how this looks as a risk to your investor. If you are a sole trader and you have a heart attack, then what's happening to your business? You know, what happens to their investment in your business? So try to put yourself in the shoes of whoever is lending you money to see, like, how do you de-risk your business for this company, for this individual, for this organization. And one of the ways you de-risk that is by having some redundancy in your company, to have a team, to have somebody else who can take over if you're hit by a bus, or you have long COVID or whatever it is. The business will go on, and that's I think key for anybody who's going for a loan or for capital or for grant, to think about is how do I look risky to them?
Yeah, so you're absolutely spot on. It's about resilience. Yep. and management structure. So if this proverbial buzz that's driving around everywhere going to knock somebody over someday, what's your management structure, succession planning that will be able to come in and obviously carry you through that difficult period?
Yeah, and we're a bit low on time, but I want to get through a couple more questions if I can. There was a few questions around startup funding for social enterprises specifically, and whether, you know, whether that is available, whether that's an option for them, but also whether they should start with social enterprise specific funders or go into the kind of mainstream market. Any view on that, Adrian?
Yeah, I think it's always difficult with the social enterprise, because again, there are some funders out there that won't be interested because nobody's signing the personal guarantee or whatever. But I think if you look at one of the best social enterprises over the last 3 or 4 years has been Social Bite. You know, where everybody slept out in the gardens at -5 degrees. Certainly in Scotland, when I did it, it was -5 degrees, but they've got a great profile and a great backing there. Mm-hmm. So I think with the right support, you can get the right funding. And it's also about where do you go for your funding, because a peer-to-peer funder might come into that, or even a crowd to fund funder may come into a social buy enterprise. It's similar to not-for-profit as well. It's about being able to prove that where your break even is, and the market generation, you can generate the revenue to pay the bills. But it might not be a high street bank, but you could get a crowdfunder going out there that will raise capital on behalf of that social bite enterprise.
I would just add to that, just like take all the phone calls. It's also good practice for you in doing your pitch, in communicating your value. And you get better at this the more conversations that you have. So even if you think it's a long shot, take that long shot, because sometimes the cold call is a good call. Sometimes the thing that you think isn't going to be a good match, you didn't understand that there was an angle that investor had. Maybe that investor is actually secretly really wanting to go into a social or diversity impact startup or business. So I would say, yeah, okay, go for the ones that are targeted for social impact, but make a broad swath, because you're going to have to make a lot of contacts, and that's just the way it is. It's not going to be just like 3 calls and 3 interviews and you have the funding you need.
Yeah, cast the net wide, right? And Adrian, just coming back on something you touched on there around, actually, Lathan, you said in your last response about reducing risk. They're looking at risk exposure. One of the questions we had was quite specific, but it was around whether funders and lenders will be looking at your sort of director's personal credit history, or whether they've had family credit problems and things like that in the past. Do either of you have a view on that?
Yeah, I've touched on it probably the third time I'm going to say about personal acumen, business acumen, financial acumen. All funders will do personal searches on directors of the companies, predominantly either 20 or 25% shareholding or more. And it's about understanding the story. So if you go back 30 years ago, when there was a lot of objections to council tax, then you didn't pay your council tax because you objected to it, and you can explain the story. Other things where businesses maybe had mobile phones on behalf of employees, and they've fallen out with E or whoever the supplier of the mobile phone is, and it's £500, it's been paid, it's satisfied. Generally, if we can understand the story of the dispute, a lot of ones you get is where there's maybe been some contractual work, a plumber, an engineer, a builder doing certain work for you that hasn't been satisfactory, and you've held back, and all of a sudden there's a CCJ against you. If they're paid and they are dissolved and they're clean, then most funders will say, okay, we can understand it. If they're still outstanding, we need to be able to tell that story and explain the rationale about why it's outstanding, because you'll not get any funding in the world without a personal credit search being done against you as an individual if you are a director of a limited company. Yeah,
makes sense. Brilliant. Listen, guys, that is, I'm afraid, all we have time for. But what a brilliant discussion. Thank you so much for your time and your insights. Really enjoyed it, and I'm sure our audience took an awful lot away. I'd like to take this opportunity to thank you both, Lathan and Adrian. I'd also like to thank our partner for this session, Dell Technologies, and to remind you that you will be emailed a voucher from Dell Technologies after this event that includes details of a host of exclusive discounts on Dell Technologies products and services. And I think you can see that on the screen right now. And finally, I'd like to thank you, the audience, for joining us, and to remind you that you can find a whole host of additional webinars, podcasts, and other content on the big issues affecting small businesses at the First Voice website at firstvoice.fsb.org.uk, where you can also subscribe to our webinars and podcasts. Many thanks for your time.
Thank you so much. Such a pleasure.